We've also got Mahesh Misra joining in of IMGC, and let's get into a conversation with him. Lots to discuss in terms of what HFCs are seeking, insurance for their loans, worrying about underlying quality of loans as well, and financial health of borrowers. So many issues currently top of mind. Mahesh, thanks for joining us. If people begin to default on their mortgages, I mean, one can surely say that the defaults in other less prioritized loan segments are also likely. People are more focused on keeping their homes safe. What, according to you, is going to be the scenario as it unfolds?
So, in a period of economic uncertainty that we are currently witnessing, I think some level of increased default is sure to happen. People will want to keep their homes safe, but there is no getting away from higher unemployment. There is no getting away from struggling businesses. So people will fundamentally have reduced ability to repay. So there is no getting away from higher default. What we see is, on an average, and depending on whether it is private banks or housing finance companies, the percentage of people who have opted for moratorium is anywhere between 28% to as high as 45% in certain cases. Whether it is a cash conservation issue or a solvency issue will kind of pan out, but while people will want to keep their homes safe, I think circumstances will compel slightly higher defaults going forward.
Okay, so you are anticipating that then. What's changed also in recent times which makes the cost of these products justifiable versus, how they were considered too expensive in the past?
See, the cost of the product is actually not very expensive when you look at the higher loan amount that borrowers are able to get. In fact, the cost is as low as, on average, as a ballpark, as low as 15 rupees to a lakh. What really matters is what is the value that one is able to provide to a borrower. So far, guarantee products are used largely for affordable housing, and that too in deeper geographies. In fact, nearly 90% of our book is for people who are eligible for the Pradhan Mantri Awas Yojana. So what really makes the proposition valuable is that borrowers are able to, on an average, get 20% higher loan amounts, and typically from lenders who would not ordinarily lend to them, and they are able to access finance at a lower cost. So actually, in a financial sense, it is hugely beneficial to borrowers, especially those in the affordable housing segment.
All right. Mr. Misra, thanks for joining in. Now, what is going to be the added cost to the housing finance companies, banks and NBFCs who decide to avail these products?
See, depending on, we typically price this product after taking a look at the existing portfolio of a bank or a housing finance company. So far, the top 5 lenders who account for nearly 50% of the industry already deal with us. We deal with the top 5 lenders who are able to use the guarantee in order to access the informal income segment in a more structured fashion. What we now see is interest from the smaller housing finance companies. They have typically already operated in the higher risk segments because their cost of funds are such that they need to lend at higher, at higher interest rates. They currently have a liquidity situation where their risk appetites are lower, and therefore they typically come and seek a guarantee from us. On an average, the cost of a guarantee is just about 0.25% a year, which also gets factored into the EMI. So from the borrower's perspective, actually, it's not really a huge outflow, especially considering that they get a 20% higher loan amount typically.
Okay, fair enough. And how exactly do these products function? Could you give us some sort of examples as to how they would look to mitigate risk for these companies?
Yeah, so typically, our portfolio is evenly mixed between the salaried and the self-employed segment. So typically, for example, one of the most popular products we offer on the salaried side is tenor extension. Typically, loan tenors are capped at age of retirement. with a guarantee, people are able to offer you loans up to 6 to 7 years after retirement. That in turn reduces your EMI, improves your affordability, and you're able to opt for a housing loan. Similarly, on the self-employed side, most organizations have a cap where they look at your loan to value and your debt burden, and then there is a cap. Using a guarantee, they are able to kind of enhance their cap, and again, somebody who was eligible for a 10 lakh rupee loan is typically eligible for a 12 or a 13 lakh rupee loan. So the value really is in improving affordability for the borrower.
All right. Thank you, Mr. Misra, for taking time out, joining in and giving us a sense as to what exactly this guarantee exposure really means for some of those housing finance companies.